You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home.
And welcome, everybody, to another episode of A Smarter Way Home, home buying strategies for consumers and real estate professionals alike. My name is Victor Bals, 20 years mortgage experience. I am here with my co-host, the loan officer extraordinaire, Mrs. Danielle Boote. How are we doing today?
I'm doing great, Victor. How are you?
All right, and we got a pretty exciting show, and you know we got Mr. Barry Habib on, and I would like you to introduce him, and let's talk about who our people are going to talk to today.
Absolutely, my pleasure. So Barry Habib is an American entrepreneur and frequent media resource for his mortgage and housing expertise. He is an Amazon #1 best-selling author for his book, Money in the Streets. He has had frequent appearances on CNBC and Fox. He is also the CEO of MBS Highway, the industry's most highly regarded and recognized tool for transforming salespeople into advisors.
That we use every day.
Every day. He has had many notable awards throughout his career, including a 3-time Crystal Ball Award winner for 2017, 19, and 20 by Zillow and Pulsenomics for the most accurate real estate forecasts out of 150 top economists in the U.S. He also was awarded in 2019 Mortgage Professional of the Year by the National Mortgage Professional magazine. In 2019, he was also a finalist for the prestigious Ernst & Young Entrepreneur of the Year Award. He was also named the esteemed Mortgage Global 100 list for 2020 and 2021 by Mortgage Professionals. As an innovator, Barry has founded many successful businesses across different verticals, including Mortgage Market Guide, Healthcare Imaging Solutions, Certified Mortgage Associates, founding partner of Social Survey. During his mortgage sales career, Barry personally has originated over $2 billion in loans. He was the lead producer and managing partner for Rock of Ages, the 27th longest running show in Broadway history. He produced Chris Angel's Mind Freak at Planet Hollywood in Las Vegas. He is the highest rated speaker and trainer for over 25 years in mortgage and real estate. And Barry also founded Certified Mortgage Advisor course that is renowned for elevating the level of professionalism and mortgage knowledge in the industry. So thank you, Barry, for joining us today.
Thank you.
Wow, that's an impeccable, unbelievable resume, Barry. And a couple things we would like you to talk on today, just to put your knowledge out there, is one, the big question that is arising to all realtors and mortgage individuals is there going to be a bubble? Are things going to pop? And we'd like you to also talk about the CMA course that you have for the loan officers across the country, which we at Highlands Mortgage, I think, we're one of the biggest mortgage companies or with participation, and it's just a great thing. Please take the floor and tell us what you do.
So if you're thinking about a housing bubble, you're right that a lot of people are talking about this. We don't really see that as something that's imminent. In fact, we think that this housing boom will continue for at least some bit of a foreseeable future. I wish that appreciation wasn't as strong. You know, we're talking about appreciation levels right now of almost 20% year over year. That's a pretty darn hot market. And it really stems from, just like anything else when it comes to price, price discovery happens between supply and demand. So there's just a lot of demand right now, and there isn't enough supply. Now, it is true that more supply is coming on the market, but it's estimated that we have probably about 3 to 4 million, maybe more, of a shortage of homes before we reach a level of equilibrium. Even if we are overbuilding, perhaps into the future. Now, it's difficult to deliver homes today because, you know, there's chip shortages and all homes require things that are computer generated, like, you know, your washer dryer, your dishwasher, your refrigerator, all the appliances have microchips in them. So it's a little bit difficult to get these deliveries. I mean, we're all experiencing it. I mean, if you tried to buy a car, it's hard to do. Your used car is probably worth more than what you paid for it in many cases.
Yes,
So
it is.
this is something that isn't going to turn around instantly. And now, obviously, with this Omicron variant of the COVID strain, this could put a wrinkle in things. Let's pray to God that it isn't too bad. But one of the reasons why the markets are in a little bit of disarray today is due to the fact that the CEO of Moderna made a couple of comments that it appears that the vaccines may not be as good against this, and the efficacy could drop significantly. So the markets didn't like that. And then you got Jerome Powell, our Fed chair, today also said that he thinks inflation is going to be problematic. So, a few things here that are, a little bit of turbulence that we have to navigate through. But when we take a look at, even if getting back to the overbuilding situation, even if you're overbuilding by 400,000 or 500,000 homes a year, you think about that, you got a shortage of 3 to 4 million. So it might take several years before things start to significantly change. So we think that appreciation in 2022 looks pretty darn good. In 2023, we think it still looks pretty reasonable. The further out you go, it gets a little harder to forecast, but we see strength in home values and home prices. So if you're thinking about buying a home, I know it's hard because you get outbid. There's not a lot of bargains out there. There's limited inventory. It's hard, but it's worth it because I think you will be successful from a financial standpoint on deciding to make that purchase. Even though home values have gone up, they appear to us as if there's quite a bit of room still to go in home values.
Well, what we've seen here in Michigan, or especially Livingston County, Michigan, is that we had people throw in the towel, Barry. I'm sick of it. I'm getting outbid by 50 offers, and I'm not paying 20,000 over, 50,000 over, and they tend to throw in the towel, and they think they're going to wait for this for prices to come down. And we're seeing they're not coming down. They may be stabilizing a little bit, but what we're seeing is these people that threw in the towel. Now they're starting to come back in the market, and they're finding themselves in the same situation again.
Well, Livingston County, you've got the need in the next year for about 1,600 homes, because that's, when you look at demographics, how many first-time home buyers there'll be. There'll be about 2,000 households formed in Livingston County. Of those, because you have a high home ownership rate of like 85%, you're going to see about 1,600 purchases of homes from people that are currently either living with mom and dad or renting. So that's what you're going to see happen. That means you have to have a way to supply that. The only way the supply comes is from a builder. And building permits for Livingston County are only 700 homes, 718 to be exact. So when you take a look at the shortage of homes in Livingston County, it's not getting any better, at least in the next year or two. And when we look at it overall, what you're probably going to see is you're going to see somewhere in the neighborhood of 5 to 6% appreciation in the next 12 months. And over the next 5 years, around 26%, 25% appreciation. So the way to correctly think about this is that, look, the median home price there is about $300,000. So if you got to go $20,000 over that median home price, which is a lot, or let's just pick a round number and say 15,000, because that's 5%, okay? So if home values are going to go up like 6%, you're probably looking at 9 months or 10 months to break even. That's not that bad. And then when you look at over the next 5 years, you'll probably make about $75,000 in appreciation in the next 5 years. So, okay, I paid over by 20. So that means in the next 5 years, I'd still make $55,000. So I mean, these are the ways you have to evaluate these things.
Mm-hmm. And we're looking at those numbers, and we're trying to explain it to our consumers, because I bought my first home back here in 1998. And when we look at the Livingston County median income at $86,000, we're the highest in the state here. That home today is more affordable than when I bought it in 1998, and people are having a hard time understanding, how could it be more affordable? It's $300,000, and they don't seem to understand those numbers, but it is actually cheaper now than it was 24 years ago.
Yeah, your affordability ranking is very, very high. It's very, very high. The median income can afford about 220% of the median home price. So the median income, because it's, as you said, it's close to $90,000. And the median home price is about $300,000. You could probably afford a $600,000 or $700,000 home. That's a really high affordability.
Yeah, and it's a great county. It's a bedroom community. What message would you have for our realtors struggling and trying to, I guess, get this experience or this understanding over to the consumers? What I guess inspiration or knowledge can you give to them to take their sales into 2022?
Well, if I were a real estate agent today, there's a few things that are going on. The media doesn't really understand it, but the first thing that you're hearing is, well, there's going to be a bubble because home prices are gone up a lot. Well, the last time we had a bubble was between 2006 and 2009, and the peak in home values was in 2006. Well, home values today are about 41% higher than the peak, except that interest rates are less than half of what they were then. So they were between 6.5% and 7% then, and today, let's call it 3.25. So you're looking at less than half of what the rates were back then. If you took that home back then, say, look, let's pick a mortgage, just pick a number, $300,000, and bring it up 41%. That'd bring it to about $425,000 is a 41% increase over that. The payment would be cheaper today than it was back then because the rates are so much cheaper. But then income since then is up 55%. People on average were making $20 an hour back then. Today, the average is $31 an hour. It's a 55% increase. So the way that you qualify for a mortgage, one of the ways you qualify, you need the money, you need credit, you get collateral, all that stuff. But to qualify from an income standpoint, as you well know, there's something called your front ratio, which basically says what is the percentage of your monthly income that would go towards making the mortgage payment. And if you take that same scenario that we just went through, you need over 30% of your monthly income to buy that home, which was 41% cheaper in 2006. Today, you need less than 20%. So you need more than 30% of your income then. Today, less than 20% of your income today. So even though values have gone up, it's much more affordable. And the other thing people think about, as you mentioned it earlier, maybe I'll wait on the sidelines. Let's see if you wait on the sidelines, it's going to get harder. It's going to get more expensive. And probably now, again, this Omicron variant could put a wrinkle in things and could cause some changes interest rate wise. But we see a little bit of a move up in interest rates, nothing too crazy, but that means your payment's going to go up, plus the value of the home goes up, plus you're missing out on the amortization, which is the monthly payment portion that goes towards principal, towards paying down your loan and reducing your payment. So you're going to get a triple whammy by waiting. I'm not saying it's easy, but you should really try your best to take action today. And if that means maybe paying a little bit more for that home, don't do it willy-nilly. Use the help of an advisor like both of you who could look up and see how long it would take to break even. You can see what the appreciation forecast is in their specific zip code. So these are the things that somebody like yourself can really, really help that customer.
Yeah, and we're very appreciative, too, of all the tools you have available on your site on the cost of waiting, the appreciation index and all that. And actually, when I used one of those charts there, we took that $300,000 home with a 5% appreciation. That's $15,000. That means next year, you need to save $1,250 after payroll taxes a month just to keep up with appreciation.
Or borrow it and have a more expensive monthly payment with a higher interest rate on the overall too.
Yeah. Barry, could you touch on one of your episodes? You talked about the euphoria of the stimulus. And you talked about everybody's out there spending money, and once this wears off, they're stuck with the debt. Could you talk about that example?
So debt tends to slow down economic conditions, and we saw it in 2020 when we had 2.8 trillion in stimulus between March and April of 2020, but by October, November, the economy was already slowing down. This year, we got the tailwind from in December of 2020, you got 900 billion, and in March, 1.9 trillion. That's 2.8 trillion again, and we were already seeing a slowdown. The third quarter gross domestic product of the United States was thought to be 9% by the Atlanta Fed and the Cleveland Fed, who do the forecasts on these things. Then they cut their forecast to 6. Then they cut it to 3. Well, guess what the number came in? At 2%. This is after all the stimulus. Now, we just passed another stimulus package, and maybe we'll get one more, but that'll probably be it. So by 2023, it looks like this runs out of gas a little bit, and we see potentially recession-like conditions, or at least a good slowdown. That means that you probably have an opportunity to see lower rates at some point in the future because of the economic slowdown or recession-like conditions. Now, that's assuming too that what we're seeing with inflation kind of slows down a little bit as the supply chain gets a little better. We hopefully get these wonderful scientists to come up with a booster shot to over the next 90 or 120 days to get us more comfortable with this Omicron variant. So these are important things. This Omicron thing, it's scary because it's presumably a lot more contagious. We don't know if this is more dangerous, meaning more virulent or more deadly. We don't know that because we don't have the data yet. But it's originated in South Africa. Now, South Africa, it's a kind of an interesting place. So it's like an incubation area because 20% of people in South Africa are HIV positive. So there could be some situations there, but by the same token, it's a very young population. Only 5% are above age 60. So the data we have for South Africa might not apply to Europe or the United States. So we have to kind of wait and see. And plus, there's a very, very low vaccinated rate in South Africa. So we'll have to see, and we're going to get this data in the next 2 weeks, 4 weeks. So we'll know if the vaccines that maybe if you've taken a vaccine and with a booster, if that's good, or you're going to probably need them to come up with something with a booster. But at least we do have some therapeutics that can help. So we just got to pray to God that, we get through this thing. And if the world gets to a better place, and that as a result is an inflation, benefit, we have less inflation, then I think you could be in for really, really low interest rates in 2023 or 2024, like really low, maybe all-time low interest rates as the economy gets off the juice of this steroid that it's been on with, all this stimulus, which is, it's like we're like a junkie.
Yeah, is it like somewhat artificial?
Somewhat. It's all artificial.
All artificial.
All
yeah.
artificial.
Well, because it appears to me, and I was thinking about this on my way over, it seems that interest rates love bad news. Anytime we have bad news, rates seem to go low, with the exception of inflation. That seems to be the arch nemesis of
That's
it.
correct,
But,
because inflation eats away the value you receive on the fixed payment as an investor. You're getting a fixed payment on a bond like a mortgage, and that doesn't buy as much when prices go up. So over time, that value, the buying power, gets eroded. And higher inflation, more rapid erosion, the only way you can protect yourself is to charge a higher rate. But everything else is bad economic news means I want to go someplace safe, like a bond. And also bad economic news means the economy slows down. So the stock market isn't as good a home because the economy slows down.
Okay.
So I have a question, I guess. Barry, I heard you speak about 4 years ago at a conference, and you had showed a chart and talked about the Millennial Generation. And I remember, hearing you speak 4 years ago and went, oh my God, I haven't heard any of that in the news or in the media about how big this Millennial Generation is and what that means to the housing market and new housing formation in this country.
So, yeah, we try and bring up a lot of stuff that people don't talk about, but specifically what we tried to show was that the median age of a first-time home buyer is 33 years old. So today's first-time home buyer, they were born, let's call it the end of 87, the beginning of 1988. That's when they were born. And when you take a look at what happened to birth rates in 1989, 90, 91, 92, there's an explosion that occurred. And that rise in birth rates that we're about to see result in 33-year-olds coming to the market in larger and larger and larger and larger numbers suggests to us that you're going to probably have a good amount of demand that want to stop living with mom and dad. I mean, I don't know how many people want to be like the movie The 40-Year-Old Virgin, living with mom and dad at 40. So they probably want to get their own place. Now that demand is going to either hit rents or it's going to hit purchases. Either one's going to raise real estate values. Remember, rents are no picnic. They've gone up year to date 17%, probably going to see a 20% rise year over year in rents. But then rents, what's worse about it is you get hit between 5 and 8% every year after that. So rents are very, very difficult on your cash flow always. At least the purchase, yes, I'm not saying it's easy, But once you fix that payment in, your income goes up, that payment stays the same. Maybe the taxes go up once in a while a little bit, but this is a much better way over time for that payment to feel better. Plus, a big chunk of the payment goes to amortization, which means it's reducing your balance. It's like putting money from your left-hand pocket to your right-hand pocket. It's a forced savings plan. So that creates wealth for you, whereas all the rent creates wealth for your landlord. So these are things that people should think about. And when we took a look at that same exact chart, it helped us forecast when the housing bubble occurred. Remember, we called the housing bubble in 2007. And we, in fact, I sold my company in 2000 because we didn't like it. I was on CNBC talking about it. People used to say, you're wrong. This, that. And we showed that same chart, and we showed the opposite happening, where births declined dramatically 33 years before the bubble. So if the bubble started in 2006, let's go back 33 years. It's 1973. In 1973, birth rates dropped dramatically and stayed low for several years. Why? Because in 1973, in January, the Supreme Court ruled to legalize abortion, the famous Roe v. Wade. That Wade was the Dallas district attorney, and Jane Roe was the fictitious name they gave the woman who wanted to have the abortion and said that women have the right to choose for their body. And that decision caused birth rates to drop. Well, a lot less birth rates 33 years later means a lot less people that were looking to buy homes. At the same time, builders put up in 2006 more homes than they ever built before, 2 million units, roughly. So that created an imbalance. The same thing happened in 07, in 08, by 09, you had a full-blown housing bubble. So we look at these things. So you bring up such a good question. We look at these things and we see the opposite is what's been happening for the last 4 or 5 years. Too many households being formed, not enough homes being built. And that's why prices are going up, quite simply. And that's why there's difficulty finding a home and a lack of inventory because there's too many homes being bought. Combine that with low interest rates, you got a recipe for a really hot housing market. Now, if interest rates go up, will things cool down a little bit? The answer is will cool down a little bit. But if I'm driving 100 miles an hour down the highway and I drop it to 50 or 40, I'm still going forward. I'm not going backwards. So prices will still go up.
It's still affordable.
For many people are going to say it's a little bit more difficult. And of course, the prices go up. But incomes are going up quite a bit. And you don't have to have the same, like if home prices went up like 19%, your income doesn't have to go up 19% because you don't use all your income for the mortgage payment. You're using 20% for principal and interest. So that means if home values go up, believe it or not, 20%, as long as your income goes up 4 or 5%, you're kind of keeping up where the amount of extra money you're making could cover that payment. And today, the private sector incomes are going up more than 10%. And overall, when you take weekly earnings, not hourly earnings, because people can get paid overtime, time and a half, they work more hours, and there's a shortage of workers, that's about 8%. So you're looking somewhere in between 8, 10, 11%. Income's going up. That's more than enough to cover 20% of that income, which is all that's needed for your entire mortgage payment.
Well, many borrowers in our market are not, as you mentioned earlier, they're not spending 30% of their income on their housing expense. If it's a 2-household income, I've got clients right now that are between 10 and probably 21% of their income on a dual income household. So if somebody loses a job or a life change happens, they're still going to be able to make it and afford their house payment and keep their house payment probably. And for a lot of buyers, particularly first-time home buyers, they can stay well within a range of what rents would be in our market.
But if they're not educated, what we're finding is they still have the jitters about entering the market because they're listening to what we call, Barry, as Barstool Billy. The guy next door or the guy sitting at the bar telling them what they should do, and they're not getting the correct information on the market. When we talked about that low inventory, now you're talking 33 years later, these people that were born in 89 now, they're entering the market. We got the baby boomers like myself that can't make money in the bonds, so we're going out there and buying second homes and investment properties. The builders, they can't build the homes because 1, they can't get the workers. 2, they can't get the bank financing like they did back in 06. So they're not building them as quick either. So personally, I think we got a few good years here. Is that what you're seeing, Barry?
Like I said, the further you go out, more events can happen, but it seems to us that over the next year or two, home values should be pretty well supported. we think that home prices go up over the next couple of years. Yeah.
Wow, this is going to be excellent. Go ahead, Danielle. Would you?
Yeah, no, I took your advice a few years ago, Barry, because I've been following you for, the better part of my career, 20 to 25 years plus here. And my oldest daughter bought her first house about 6 years ago. My husband thought I was nuts. She was still in college, finishing her master's degree, working, and the rents were so high because she was closer to the Detroit area. I said, we're going to help her buy a house. So, of course, I did her loan, guided her through the whole process. She sold her first house 6 years later, made $80,000 in equity, was able to pay off her student loans and still had an ample down payment on her second home as she got married this year. So,
Well,
my
congratulations.
husband thought I was nuts when I said, no, she needs to buy a house. He was like, she's 21 years old. She doesn't need to buy a house. I
Well,
said,
you can't blame
she
your
does.
husband because that's what the media puts out there. They don't get it. You've had all these reports that renting is better than owning, and there's all these bubble fears, and it's really just generated to get views because people, when they hear bad news, they tune in more. So this is a unfortunate circumstance that people didn't take advantage of that. But it's still a great opportunity. Like I said, I know it's not easy, but it's still a great opportunity to do that because listen, if you're going to make, I think Victor was talking about the numbers before, right? You were saying on a $300,000 home, if it only goes up 5%, and I think it'll go up more than that, but if it goes up 5%, like you said, that's $15,000. That's a lot of money,
And they still got to have a roof over their head. If they're not going to buy, go find a place to rent. And now I guess I believe them because that is throwing out money. Unless you're going to transfer out of state somewhere, go get a job somewhere, you might as well buy.
Well, the thing of it is that the payment's pretty similar buying and renting today, even if it starts off a little more expensive buying. Once you consider these factors, appreciation, like we just said, so even over the next 5 or 6 years, that could be 70, 80, 90, $100,000. Then you talk about the amortization. That's paying that loan down. So now you got another $30,000 there. Then you got cash flow, which the rent might appear a little bit cheaper initially, but because the rents continue to go up, you might have another $10,000 you pick up in cash flow. And then it's possible, depends individually, but you may have some tax benefit there, especially if you're single. So you may have some tax benefit there. So there's a lot to be on the plus side of a home. Now, negatives, you got repair costs and maintenance, which the landlord would usually front out of their pocket. And then come time to sell, you might have to sell that home and pay a real estate agent for doing a very nice job for you. So you should consider those things, right? I mean, but overall, it's overwhelming the advantage of purchasing a home. It's much, much, much better by a much larger amount of money than people understand. It's could be hundreds of thousands of dollars depending on how long the time frame is.
Absolutely. And now let's just talk just a bit on the flip side of that. Because of this appreciation, we have many Americans sitting on a boatload of equity, but also they have a lot of debt out there too. And I had a client in last week, and we ended up doing a cash out refinance to pay off some debts. He goes, God, I hate to take the equity out of my house to pay off that debt. And I said, well, hold on. Let's think about that. You're not paying that off. Time is paying that debt off. Because if you were renting the last 8 years, you'd have zero money or equity to take out of that house or that apartment. But now we're letting time pay off that debt. And when we went into that, it kind of lowered his shoulders and said, I'd never thought about it that way. So where do you think?
Well, here's the way that I would think about that is that many people have debt that could be in the range of $50,000-$60,000 in consumer debt between car loans and credit cards and store cards and things of that nature, and they more than likely have more than that in equity. So the way that it would work is that you take the value of the home and somewhere around 75% is what's usable minus the existing mortgages that you might have on there. So a lot of people, based upon just the last year, have more than $50,000 usable or so. If you took that money and paid off the debt, here's what starts to happen. And by the way, let's even say interest rates, you pay a higher interest rate. Let's just get crazy and say the rate that you have is 3%. And you say, I'm not going to do it because my rate's great. It's 3%. What happens even though rates are cheaper now? Let's say rates are around 3.25 now as a ballpark, just estimated number. Let's say the rate goes to 4%. You might not think anybody would be looking at taking their 3% rate and saying goodbye and taking out a 4% rate. Well, here's what would happen in that case. In that exact case, you'd take your mortgage that you have, let's just say you got 27, 28 years left. You'd pay it off in 11 or 12, okay? By taking the debts and paying it off, and then taking the savings that you have and using that savings to pay down your mortgage on an accelerated basis. That is the best retirement plan in the world, because that means that 11 or 12 years from now, instead of continuing to make the payment on your mortgage and all your other debts, which might have been $4,000 or $5,000 a month, you don't have that payment anymore. So it's like having the best retirement plan in the world. And get this, in 5 years, you would have an extra $111,000 in equity. In 10 years, $250,000 in equity, and over $300,000 11 or 12 years down the road when the loan's completely paid off. Now you can use that $300,000 for whatever you want. You can use it for your kids' college. You could use it to buy. So, and that's taking an example taken from somebody from 3% to 4%. Okay, if you take somebody from 4% and bring them down to three and a quarter, you probably pay the loan off in 9 years or something like that, and have like 4. Every situation is different, but these are important things to think about.
It's funny you say that, because he was at 3% and we just refinanced him. I locked him at 4% because of his credit score, a little higher than market, but we freed him up $860 a month. And if he puts $350 of that, he's going to pay it off in 11 years sooner than what he's going to do. And now he frees up another $450 a month just for a quality of life. I mean, the guy's reaching retirement, and he deserves to have a fun time in life too. So.
Absolutely.
But that goes down to talking about like your certified mortgage advisors. Could you touch a little bit base on that about loan? There's a loan
So when I
officers?
created, yeah, it's amazing because, people say they're an advisor, but putting it on your name tag doesn't mean that. A lot of people that are in the arena of mortgage and real estate could benefit by this, by really becoming an advisor and transitioning from just sales into really advising. Now, if you ask, how many of these individuals really understand the Fed, really understand all the economic reports, understand how APR works, annual percentage rate, why some companies manipulate it, why you got to be careful, because the lowest APR could be the worst thing for you, how to really evaluate a mortgage, how to really do a financial debt consolidation plan for their customers, how to understand cost of waiting, how to understand when you are going to evaluate correctly, should you bid over asking price, like really get it. So this course does that for you. This is a certification. You have to pass tests, and it's not easy to do. No. But your guys' company, Highlands, you got such great leadership within the whole company, and especially Danny Deaton, Danny Deaton is one of the smartest guys out there, and he is of the highest caliber of wanting quality, and really he has the giant heart. He wants people and consumers to really benefit. And, he thinks that way first. He says, if we do something really special for our clients and really benefit and change their life, then we don't have to ever worry about anything, because our salespeople will all do well because everybody's going to tell everybody about you guys. So he's got the right mentality, and he's, as he's made all of you guys really take this as an approach that's a very serious approach. And the company went out and got everybody this certification, the course, so that you can get the certification, which is, there's very few companies in the United States with that kind of a commitment to excellence.
Yeah, I mean, and I use those tools every day. And after those face-to-face meetings, my clients ask, Vic, are you a financial planner? Are you an accountant? Are you this? I go, no, I am not that, nor am I going to say I am. But I have people that can do that. But I tell you what, it really builds a good experience with your clients, and you become an advisor. You're not just giving them a loan. You're creating wealth through a vehicle called a mortgage, and you're creating a quality of life. And I can't thank you enough, Barry, for putting that class together, because we practice what we preach, don't
every
we,
day.
Danielle?
Oh, yeah.
It really is.
And it was definitely a lot harder than we could have ever imagined. We did work at that.
You guys are the ones doing the hard work, so that's awesome.
But I tell you what, we can wrap up the show. I know we've taken a lot of time. Any closing words for our real estate agents or our consumers out there on 2022 coming out there, Barry?
Well, listen, here's the thing. The best rate on the wrong strategy is a lot more expensive than a competitive rate would be on the right game plan. And what you guys do is provide that. And as far as real estate agents and customers, what you really want to try and do is alleviate points of friction. Just the things we talked about today. Is it a good idea to bid over ask? How do I correctly evaluate that? Should I wait if I wait, what does it cost me? And this way I could evaluate that. What if I'm a little short on money? How can I create money out of thin air that doesn't have to be paid back? And these people right here, you folks can do that for them, because taking a slightly higher rate, you can get extra money that would go towards paying their closing costs, that now frees up money that they can go make that bid higher, and that money doesn't have to be paid back. So these are all things that you could do. Then correctly evaluating whether I should buy or rent, with everything taken into consideration. Now, doing a real estate report card like you guys do so well for every zip code in the United States, this is what that relationship should be like, so that that real estate agent, that mortgage professional could do the very best they can, not to sell the customer, not to sell that client who's looking to purchase or refinance their home, but to really advise them as to what to do. Look, there's so many mortgage products out there, and what you guys do so beautifully is you put it on a timeline. You show them the loan advisor tool, which allows them to do a loan comparison. And if you look at 5 products and they say, okay, which is best for me? The answer is they could all be best for you. It depends on which time frame, right? So look at a timeline, and then you could eliminate certain ones, and then you dynamically changes, and you could show these people this stuff and really make their life easier, because you are great communicators. The old saying is that, people fear what they don't know, and people also hate what they fear. So, if you help them understand and you take the mystery out of it, so they know, they will have less fear. They'll be happier. They'll make better decisions. And thanks for you guys for doing that for our industry.
Excellent. Any closing words, Danielle?
Thank you so much, Barry. This has just been our honor for you to take time and be on our podcast today. So hopefully we'll see you in Vegas or at a conference soon. But
I'm sure we will.
Everything you've done to our industry.
Okay.
Thank you, guys.
Thank you, Barry. And that's it for A Smarter Way Home. That's Mr. Barry Habib. Tune in next time. And you can also go to the mbshighway.com to get more information on Barry. Thank you very much, Barry. We'll see you soon.
Together and make this world better.